Okay, so I thought it might be helpful to provide a few extra practice problems, and so this is a fairly straightforward deferred tax liability practice problem, and so we'll just kind of jump right into it. So a firm purchased a truck on February 1st, 2020 for $25,000. There's assumed that it has a 3-year useful life and a $4,000 salvage value. They use straight line under GAAP, and then the Internal Revenue Code, they have depreciation in 2020, 2021, and 2022. And we have pre-tax financial income, some municipal bond interest, and some insurance premiums that are not deductible under the Internal Revenue Code. And so we're going to go through and get to the journal entries for each of these years. All right, so for 2020, I kind of highlighted the most important information. So first of all, the truck was purchased on February 1st, which means in 2020 we're only going to have 11 months of depreciation under US GAAP. And then we have the depreciation under the Internal Revenue Code of $15,000, the pre-tax financial income, municipal bond interest, and the insurance premium, and of course we have the tax rate as well. And so part of the challenge of these problems is kind of grabbing onto each year and getting the information that you need for that year. All right, so we start with our pre-tax financial income in order to get to our 2020 income taxes payable. First thing we're going to do is add back US GAAP depreciation. Now a full year of depreciation would be $7,000, and the reason why we know that is because the cost was $25,000, the salvage value was $4,000, which means there's a depreciable cost of $21,000, and there's a 3 years useful life, so that's $7,000 per year. And so in 2020 we would have 11/12 of $7,000, and so that's why we have depreciation of $6,417. Of course, for US GAAP to reconcile GAAP to the Internal Revenue Code, we have to reconcile the difference in depreciation, and so we add back GAAP depreciation. Then of course we do need to subtract the Internal Revenue Code depreciation, which is defined as $15,000. We have the municipal bond interest, which is counted as revenue under US GAAP but is not taxable under the Internal Revenue Code. And then we have the insurance premiums, which are expenses under US GAAP, but they are not deductible under the Internal Revenue Code, so we have to add those back. And so our Internal Revenue Code taxable income is $226,417. We apply the tax rate, which gives us our income taxes payable of $90,567. So now we're going to go through the calculation for the deferred tax liability. Again, this is just my personal approach because I think it's something that's repeatable and it's easy to understand. And so we start with the book value of the GAAP equipment. So we had the original cost of $25,000, subtract the depreciation of $6,417, which gives us a book value of $18,583. The same piece of equipment has a book value of $10,000 under the Internal Revenue Code. And so the difference in book value is $8,583. We apply the tax rate, and that gives us the deferred tax liability related to this piece of equipment with an ending balance of $3,433. Of course, this is the first year of this piece of equipment, so there is no previous balance, which means that the increase in the balance is the balance of $3,433. Okay, so now we get to our journal entries for December 31st, 2020. We start with the income taxes payable that we calculated, $90,567. We also had the increase to the deferred tax liability, which would be a credit of $3,433. And from there we derive our income tax expense to be $94,000. So now we move on to 2021. We start again with our pre-tax financial income of $250,000. We add back the GAAP depreciation, which again is a full year now of $7,000, and subtract the Internal Revenue Code depreciation of $4,000. We still have that insurance premium that we need to add back because it is not deductible under the Internal Revenue Code. And that gives us our Internal Revenue Code taxable income, $263,000. We apply the tax rate, and we get our income taxes payable for 2021. So our 2021 deferred tax liability, kind of continuing on through the process, the previous book value of the equipment under US GAAP was $18,583, which means at the end of 2021 the book value is $11,583. The same piece of equipment has a $6,000 book value under the Internal Revenue Code, which means there's still a difference in the book value of $5,583. It's a positive difference, meaning that the GAAP equipment has a higher book value than the Internal Revenue Code equipment, and that $5,583 difference is a future taxable amount of income. We apply the tax rate to that future taxable amount of income in order to get the deferred tax liability balance, which in this case is $2,233. We compare that to the previous balance of $3,433, and we can see that the balance in the deferred tax liability was reduced by $1,200. So then we get to our journal entry. We start with our income taxes payable of $105,200. The decrease in the deferred tax liability is a debit of $1,200, which means that our income tax expense is $104,000. We're going to move more quickly now through 2022. We have our pre-tax financial income. We have to adjust for the difference in depreciation, continue to add back the insurance premium, which gives us our income taxes, our taxable income. We apply the tax rate and we get our income taxes payable. Looking at the deferred tax liability, the new book value at the end of 2022 under US GAAP is $4,583. It's fully depreciated under the Internal Revenue Code, so its book value is $4,000, which means we still have a future taxable amount of income of $583. We apply the tax rate to get a deferred tax liability balance. We compare it to a previous balance. We can see that it decreased again by $2,000. Getting to our journal entry, we start with our income taxes payable, the decrease in the deferred tax liability, and from there we get our income tax expense. For the final year, I kind of moved forward very quickly. Again, we have the depreciation adjustment and the insurance premium adjustment, which gives us to our taxable income. Apply the tax rate, we get our income taxes payable. And in this case, both assets are fully depreciated, whether under US GAAP or Internal Revenue Code, so there is no difference in book value. Since there's no difference in book value, there's no future taxable income, which means there is no deferred tax liability balance. Compare it to a previous balance, and we can see we do have another reduction in our deferred tax liability. Now to our journal entry, we start with our income taxes payable, the decrease in deferred tax liability, which means we get our income tax expense.